A, we are required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure, that's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called 𝐻𝐻, a public limited company on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called 𝐻𝐻 Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent and then 𝐻𝐻 is the subsidiary. You can see also we're given the date of acquisition. Then from there, I want us to go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝑠𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝑠𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝑠𝑠 Limited. 𝐶𝑠𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph. Zido, are you there? Stephen, are you there? Sam, are you there? Martin, are you there? Mother, are you there? Doris? Anna, are you there? Lydian, do you have the question with you? Perfect, perfect. Okay. So what are we told as far as this particular question here is concerned? So this is a very good question on conversion of partnership business into a limited liability company. And the question is, that is specifically part B. So we are told John, Kelvin, and Renette have been into partnership for several years, sharing profit and losses in the ratio of 5:3:2 respectively, after allowing for a 10% interest on fixed capital balances of the partners. No salaries or commissions were to be paid to the partners. The trial balance as at 30th of June 2024 extracted from the financial records of the business revealed the following. So we're given the trial balance there. One, we have the profit for the year. We have the inventory as at 30th of June, of 2024. Account receivables, account payable, bank overdraft, property at carrying amount. Remember, I've said carrying amount is the same with the net book value. That is what you need to remember. We have the motor vehicle at carrying amount, office equipment at carrying amount, equity investment at fair value. We have the partners capital account, partners current account drawings, and then we have the loan from Kelvin. We have additional information. Number one, you're told actually in the first paragraph there, we are told the partnership was converted into a limited liability company, 𝐍𝐋𝐿 Limited, with effect from 1st July 2024 under the following terms. Number one, you're told the purchase consideration of the business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of 𝐿10 par value in full satisfaction of the purchase consideration. So the new company was to pay a purchase consideration of 150 million. This was to be paid by the new company issuing its own shares, issuing 15 million ordinary shares, each share having a par value of 10. Number two, we are told equity investment were taken over by the partners at the fair value of 18 million and allocated to the partners in their profit and loss sharing ratio. Equity investment is basically investment in shares. This one was not taken over by the new company, but rather this one was taken over by partners. So therefore, this is an asset which was taken over by partners. And then from there, we are told number three, the loan from partner Kelvin was transferred to the new company at the carrying amount. Number four, other assets and liabilities of the partnership were taken over by the new company at the following values. At the following what values? So we are given the assets which were taken over, the assets and liabilities which were taken over by the new company. We have property, we have plant and machinery, motor vehicle, office equipment, and we are given the value at which we were taken over at. Then we have inventory which was taken over at the book value less 15%. Account receivable was taken over at book value less 10%. Current liabilities were taken over at the book value. Finally, number five, we are told the new company issued 2 million ordinary shares of 𝐿10 at each at par value. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over with the balance used as working capital. So what are we required to do here? We are required to prepare the foreign ledger account to close off the books of account of the partnership. Number one, the realization account. Number two, the partner's capital account. And number three, the partner's capital account. So actually, those are the accounts which are prepared to close off the books of account of the partnership. Then Roman 4, we are required to prepare the opening statement of financial position of the new company called 𝐍𝐋𝐿 Limited on 1st of July 2024. So what we are going to do first of all is to cross off the books of account of the partnership by preparing the first three accounts: realization, partner's capital account, and then the partner's capital account. But before we do that, if you go back to the trial balance which you're given, can we go back to the trial balance? The first item in that trial balance which you're given is the profit for the year. Now, let me ask here, what happens to the profit of the partnership? If, for example, we are partners in a partnership business and our business has reported a profit, what happens to that profit which is reported by a partnership business? Who can tell us? What happens to the profit which is reported by partnership business? Where does that profit go? Where does that profit go? Is it retained as a reserve? Is it supposed to be shared? Yes, automatically, once a partnership business reports a profit, that profit is supposed to be shared among partners. We know from the definition of a partnership business is an association of partners who carries on a business with an objective of making and sharing profit. So any profit which is reported by the partnership business is supposed to be shared among who? partners. How do we share that profit? We share that profit from what you did in from what you did in the topic of partnership in financial accounting. We share out that profit by preparing something called the appropriation account. And therefore, even before we cross off the books of account of the partnership, so the first thing we need to do is to share out that profit among the partners. We are going to share out that profit by preparing something called the partners, the appropriation words, the appropriation account. So let's first of all, we prepare that account, which is called the appropriation account. So why are we preparing this account? Is to share out that profit. Appropriation what? Appropriation account. Appropriation account, and I hope you can be able to recall the format for this account, the format for appropriation account. Okay, so the figures which are given here, they are in million of shillings. So basically here, we should have two columns like that. So in preparing this particular account here, we always start with the profit for the year. Profit for the year. I hope you can be able to see that far ahead. We always start with the profit for the year. And then to this profit, we usually add the interest on drawings. We usually add the interest on drawings. The interest on what? The interest on drawings. After adding the interest on drawings, which is charged to the partners, we then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit. The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check what the partners charged any interest. When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that money should be added to the amount to be shared. Yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Renette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2. After allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the loan from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what? All commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? and Rinette. So, and we are told that this one would be 10%. This one would be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Rinette is 18,800. 18,800. 10% of that will be 18 what? 1880. 18 what? 1880. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa, Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna. Maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So in our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business. So then from there, the other appropriations the partners may be entitled to, is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, we're going to have a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So you have 42,800 minus 43,70 minus 28,50 minus 18,80. So the amount to be shared as profit, I'm getting 33,700. Now that profit would be shared among our three partners, John, Kelvin, and who? And Rinette. So they will share a profit of 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3 is to 2. 5:3 is to 2. That is for John, Kelvin, and what? And Lynette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Or the losses, Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest, because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Awesome? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and Lynette 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16,850. Kelvin, we take 33,700 times 3 divided by 10. And basically that will give us 10,110. And then the other partner Lynette, that is 3,700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0, because that amount of profit has been shared among who? Has been shared among partners. Now, once you're through with that, then we can proceed and basically cross off the book of account of who? Of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. Realization account. So what we just need to remember here is what do we record in this particular account, the realization account. What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is the ledger account. Is the ledger account. Partners current account is basically a ledger account. Ledger account means that This account will be having a debit and the credit side, the debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here. And then column for the 3 partners. We have the first partner, who is John. We have Kelvin, and we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John. We have Kelvin. We have Renette. This, remember, is the credit side. And also the figures are in what? In 1,000 of shillings, like that. In 1,000 of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to close all those accounts. You close off all those particular accounts without skipping any. So the first item is the net profit. Now this net profit, we know that this one has been shared among partners. And therefore these particular items here, that is the any interest on drawings, any salary or commission, any interest on capital and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information note number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which I have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partners' capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities, all those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance, not the value which is given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23. Then I hope you can see values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa? Yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company, in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note here, no. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember, this is an asset. This is what? An asset. So therefore, these are debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need, first of all, to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we are crediting this account, which is called equity investment, with 10,000, Then we will debit this account. We will debit the partners capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference, which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually this difference, we can refer to it as a revaluation gain, because when this equity investment were taken over, they were revalued from 10 million to 18. So this is a revaluation gain. Now this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment, which is 8. Then we need to debit this account with the 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see that there's nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partners capital account. Now the partners capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the balance. They are on the credit side. So what we do, we record those balances here and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800. 18,800. 18,800. 18,800. 18,800. 18,800. 18,800. Yes, so then from there, below that we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For John, it is 14,790. For Kevin, it is the 12,960, 960, and basically for net is what? 98.50. 98 what? 98.50. 98 what? 50. 98.50. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in these accounts. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in these accounts. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here, but I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here, and then in this account of the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of what? What you have said is that they are 18 million. It's a value of 18 in note number. We have shared a value of, that's what